You've probably seen them splashed across your social media feeds. ETFs that hold just one stock but offer 20, 30, 40, even 50% income yields. They sound incredible, and some investors are convinced they're the secret to a richer life. But are these funds too good to be true, especially during times of uncertainty and volatility? Well, we're going to go straight to the source for the answer on this one. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. And today we're going to explore single stock ETFs with very high distribution yields. Okay, we're going to unpack how they generate returns, if these super high yields are sustainable, and what the future may hold for these ETFs as volatility rules the market. We're going to set the record straight with someone who knows these ETFs best. Joining us is Paul MacDonald, Chief Investment Officer at Harvest ETFs. Harvest is one of the biggest providers of single stock ETFs in Canada, with 15 in their lineup today. Paul, great to have you back with us. Thanks for taking the time.
Yeah, thanks for having me back, Rob.
Good to have you live in the flesh, I was going to say. Yeah, we had you back in February remotely. It's a little bit cozier here. I like it. Before we get into sort of the mechanics of single stock ETFs, they've definitely captured a little bit of a cultural zeitgeist on the likes of Reddit, what have you. I think at first blush, though, some people might think, single stock ETF, why would I have an ETF with one stock in it? What's the point of this? So, where is the demand for this coming from, and what solution or problem does it solve?
Yeah, so we launched our lineup last year at Harvest, and we currently have 15 single stock ETFs and one basket that holds 15. So it was about 4 years ago or so that the regulations changed that allowed us to actually hold an individual security in an ETF. And so why somebody would want to do that really comes down to, one, they want to own that individual stock, but then there's actually some strategies that you can actually employ within that ETF that perhaps investors either can't do on their own or don't have the time. And then there's also some other features like modest leverage. So for us, what we do, we use covered calls on individual stocks. They can buy them in the Canadian market. Typically, the price point for them to come in isn't as high as a lot of the underlying stocks. And it's all, like I said, because it's in a mutual fund trust, actually is considered Canadian. The real feature, though, is having the ability to add on a covered call strategy for those that perhaps want to participate in the long-term growth of an individual name, but then they also get a high monthly cash flow or income from that option strategy.
Yeah, a lot of these ones that I've seen on the market here, they're in those high growth names, a lot of tech stocks or really recognizable brands, and certainly options writing can be really interesting and profitable for some, but there's a lot involved. Not everybody wants to necessarily juggle all that stuff. So I can understand the need for the product here. They've definitely sort of captured a moment on the Reddit circles and stuff like that on social media here. I feel like some people, at least from the comments that I've seen, feel like these things are a little bit of a way to speed run to financial independence, if you will, right? You get income today, these really high distribution yields, you're freeing up capital that you can then invest elsewhere, and I think there might be a perception among some circles that these things are almost like a cheat code to investing, if you will. What's your take on that read?
Look, it really comes down to, are these the individual stocks that people want to own? And if so, how does that fit within your portfolio? These are, widely recognizable names. Out of our 15, 13 are in the NASDAQ. In our portfolio of 15, the market cap of these 15 stocks is 30 trillion versus the TSX at 5. So this perception that this is, micro cap, deep end of the curve type of positions. Yes, they do command some higher risks in some cases, but really this is more about, do people want to generate some cash flow from these individual securities, and do they want to be holding on to that particular position within their overall portfolio?
Okay, so we're not short-circuiting the markets here in some way, right? We are getting income, but we are giving up some upside, right, when we use these things?
Yeah, there's no free lunch. We joke about it on our desk that other than perhaps diversification. And so there is a risk, there is a return. And so for most people, hopefully we'll get into some of the mechanics on just exactly how the options work in scenarios scenarios where they work really well and perhaps times when they don't work as well. So again, it's risk return, and there's no free lunch, as we said, but certainly having the ability to generate high monthly income from these stocks and still participate in some of the upside as they grow over time, I think is a really unique feature that has come to market over the past couple of years.
Mm-hmm, totally, and this is always like a case where like the truth lies somewhere in the middle here. So it looks like that's what we've got in this case. I want to talk to you about retirees using these products because some feel like it's a great idea to live off the really high distribution yields that you can get from these things, but opinion is divided. And actually, we recently spoke to 2 early retirees who expressed some skepticism around the single stock ETFs with really, really high yields. So let's hear what they had to say.
You also have to make sure the fund is ideal for that because you have these, especially in the US, you have these very, very high yield, 30, 40, 50, 60% yield funds. If you're just pulling out the entire dividend every month, well, those are not ideal to live off of. So you also have to make sure to choose funds that are ideal to live off of. My personal sweet spot is in the 10 to 15% range. After 15% yield, most likely you're going to have no choice but to reinvest a portion to maintain that capital, right? Because let's be honest, the market returns 10 to 12% a year on average, right? So if you're getting 10, 12% yield with these covered call ETFs, most likely your capital will remain relatively stable and you could spend all the income.
So, Paul, what do you think about what they were saying there? Adrian kind of felt like the sweet spot is somewhere in the 10 to 15 range. He was a little bit skeptical of living off of these super high distribution yields in retirement. But what's your take? Can you bank a retirement on these things? So
look, I think for retirees in particular, you have to look at your overall portfolio. And as Adriano pointed out there, in the US in particular, some of the strategies are 100% writing on highly volatile names. In our view, that's not a sustainable approach. Similarly, if a particular stock or a fund for that matter, a Canadian utilities fund has 15% yield but can only generate 9%, that's absolutely true for retirees. You'll have to be putting capital back in, or you will have some capital draw unless the stocks go up. And so you will need that to happen. So when we look at our high income shares, yes, there's nothing for nothing. They generate big cash flow. There's certain things that we have to have happen for us to be able to continue to pay high cash flows. A couple of those things are we need to have volatility in the market, and these stocks tend to be fairly volatile. And we do participate in the upside over time as well. But there are certain scenarios where, do you know what? For a retiree, do you really want to have your entire portfolio in high growth stocks that are generating income? Probably not. But if you are a retiree and you have a component of your portfolio in, higher risk areas, in particular, higher growth, then it certainly would make a lot of sense for that portion to be generating some cash flow for you if you are needing to have that cash flow.
Mm-hmm. So again, it sounds like there's some nuance involved with using these products, but there can be a role for them if it fits your risk appetite here. So on that note, maybe let's get into how the mechanics of these single stock ETFs work here. And for those in our audience, if you want to get in on this conversation and have questions to ask, we'd love to hear them. So let us know what you want to talk about here, and we'll pitch as many of your questions to Paul as we can. If you're watching on Webroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, just click on the link in the description. It'll take you over to our broadcast platform, and that's where you can ask the questions. Okay, Paul, let's lay a little bit of groundwork for our audience here. Single stock ETFs, break it down. How do they generate the returns that they do?
So for us using the covered call, it's very similar to many of the covered call strategies that are out there, with the difference that in a portfolio, say, of 20 stocks, you've got different moving parts within the portfolio every month. So within our portfolio single stocks, we use covered calls. And what that does is it means that for giving up some of the upside, we get some cash flow every month. And so we can certainly go through some examples, but the short version is we own the underlying stock, we write options against it, we get cash flow for that, and we pay that cash flow out every month.
Okay, and explain it to me like I'm 12, Paul. Maybe I, like some of the viewers, didn't participate in Options Education Month in June there, so can you break it down in as simple terms as possible? How does options writing work?
So, and I'll preface, I'll give a simple example. These numbers are just for simplicity. And we write generally about 33%. We can go up to 50%, but we've capped it at that and mandated it. And so in this example I'll give you, it'll be 100% right. And let's assume $100 stock, and I write an option on that stock, and I get $3 of premium for simplicity. The stock goes from 100 to 110. I still have $3, but I sell my stock at 100. The stock goes from 100 to 90. I still have that $3. So the old saying, a bird in the hand is better than two in the bush. True. So we're not writing the 100% though. So in that example, you'll go from 100 to 106.67 if you're writing 33, versus, but we still get that dollar of premium. So we get to pay out, relatively high cash flow, but we're not giving up that upside. Now, if it goes from 100 down to 90, yes, we've still generated that $1 of cash flow.
Mm-hmm. Okay. And when you say like you're writing 33, you mean 33% of the portfolio?
Of the position, that's right. So we're not participating on that portion that is written.
Okay, so the ones that some of the ones that we see in the United States where they have like uber high, 60% plus, even like ones that presumably they're writing like closer to 100% of the portfolio.
Generally, that's what we've seen, and you can really see. Yes, you've got a big total return, but the propensity for your net asset value, if the stock sells off down to 90, for it to recoup and go back up, is much lower because you're writing away 100% of that upside even from 90. So the quid pro quo with ours would be, yes, you forego some of the upside. You don't get near the same sort of 100, and I think so at one point one of them was 160% annualized yield. You don't get that with ours, but you don't have that same sort of trade-off if you get a sell-off in the market.
That 160, like how do you even get something that high? Like how can it be over 100?
It's quite phenomenal. The way that options are priced is off of volatility.
Right.
And so, and not just how volatile the stock has been, but it's actually off of something called implied volatility, and that's how volatile the market is expecting the stock to be. So you might have a flat stock price, but their earnings are coming up in 3 weeks, and therefore the premiums are very high because the expected volatility is going to be high. So in some of these cases in the U.S., companies like MicroStrategy, there was some very, very high implied volatilities in very short periods. So that resulted in some big, very almost eye-watering types of yields on the options.
Yeah, and I can totally see how that would be very alluring at face value to a lot of investors if they're very income focused, saying like, hey, wow, I can get so much here. But on that point, are funds like that, in your view, sustainable? If you have something that's like a 60, 70+% distribution yield, can that last?
So it's a function of volatility, and will that volatility be there and stay? Number one. And number two is, and I think this is really, when I've read various types of Reddits, I think this is probably the missing piece of the puzzle, is that foregone upside is on a monthly basis. And so if you're foregoing, and it becomes more pronounced as well, if you're writing even shorter term. So if you're writing, weekly options, you're foregoing that upside on that weekly or monthly basis as you write. We typically are writing monthly options. And so if you're writing 100% or 50+%, yeah, I don't think that those are sustainable. I think over time, the propensity for your stock to, recover post sell-offs is, from a fund perspective, is much, much lower. And so the nice thing is when, at least during initial corrections in markets, quite often what we see is, markets take the escalator up and the elevator down, as one might say. So as markets sell off, that implied volatility does quite often peak. And so we can sustain through sell-offs as long as that volatility remains. Now, kind of the scenario that we talked about earlier that, is not one that we would want to have, is a sharp correction in the market and then have volatility go away. And so I know that was a long answer to the question, but that kind of gives a bit of a perspective on, why some of those 100% right funds I don't think really do make as much sense as I know. Perhaps you make the call right, and if the stock is flat, you've generated, massive returns relative to the underlying. So.
I've never come across an explanation of anything options related that was super short and concise and easily summed up into, it's like a can of worms that just like keeps spewing forth. But I thought you did a great job there.
Thank you.
So take me through some of the levers then that would make a really high distribution yield possible. Like you talked about monthly options writing. If you write shorter time frames and more of the portfolio you're writing options on, that increases the distribution. Is that how it works?
That's right. And the flip side, or the quid pro quo, is if you're writing shorter durations, you're not giving the upside over the course of a year. You're giving it up if it goes up 10% in that week, and you're writing weekly options. You've missed out on that 10% over that week, but you'll still have the downside if you're writing 100%. And so from our perspective, when we look at the implied volatilities and how we're trading our options on about a third of the portfolio, we really haven't come across any situation really that has seen, meaningful drops in implied volatility.
Mm-hmm. Take me through, like, just to play devil's advocate here, I can see some of the really like pro single stock ETF folks saying like, well, why do I need to care about the stock price, right? Like, just give me the high distribution. Like, I don't really even care what it does because I'm just going to hold the fund like in perpetuity. Doesn't matter, and I just keep collecting my massive distribution. Yeah. Like, what are they missing here? Why is this not free money?
Well, again, if you're getting that 3%. I'll even make it more simple so I can do the math. So let's say I'm getting 2% on $100 at $90. If volatility stays the same, I'm getting $1.80. 2% of 90. And so, the stock price does matter, but typically, like I said, when stocks go from 100 down to 90, they don't do so gently over the course of, weeks. It happens usually fairly quick, and implied volatility tends to spike. So quite often what happens is, at least in the shorter term, is you get that original 2%, perhaps you're now generating an equivalent of a 3% yield on $90. And so the other option for us that we have within ours, we can go up to 50%. So there are times when we've seen stocks sell off, volatility stayed the same. Our write levels have gone from 33 to 40%. So you can write a little bit more and forego the upside. And we do publish that information on a monthly basis inside our newsletter, how much we're writing. And then the flip side, just to keep our distributions, as close to the stable as we can every month. Sometimes there's cases where the stock price has gone up. We can generate a little bit more, but we'll just write a little bit less, typically 25%. And a couple great examples. We've seen Tesla get beat up really hard. The quid pro quo to that is within our lineup. We've got Palantir has doubled. And so the upside potential here, we're talking about kind of the negatives. The upside potential is if the stock prices appreciate, we started out at a 37 cent per $12 unit in Palantir, and I think that was earlier in February this year, and currently it's at 55 cents. So we've actually been able to increase the distribution. So there's both sides to that equation, and it works both ways, but it doesn't work both ways if you're writing 100%.
Mm-hmm, mm-hmm. And just so people kind of understand how this works, if you is there any way to, I guess, hedge or counteract the downside potential that you would get if the stock were to decline and you're holding a single stock ETF? Can you hedge against that risk basically elsewhere in your portfolio in some way?
No, there's a couple things. Again, we could open up a whole can of worms here, but I'll bring it back to, that individual stock. And, we kind of talked about, retirees and some younger investors. We talked about our ESPs earlier, start early, trust me. Mm-hmm. And so, when people are building out their portfolios and we're talking, hey, here's a single stock ETF, and as opposed to going, hey, this is Eli Lilly, or this is NVIDIA. These are well-known names. I think the first question people have to ask themselves is this a position that I want to own? Mm-hmm. And now I can't give advice to say don't put 75% in MicroStrategy and 25% in Coinbase, and mea culpa, I would have been wrong, because that has worked. But generally, I think people should be looking at should I be adding this stock to my portfolio? And am I okay to give up some of the upside in favor of that cash flow? And how does that fit within everything else? So to answer the question really quickly is absolutely, I think there's other areas. The market doesn't always, sing in the same tune or, play in the same note at the same time. So having some diversification, that's, I think, really important in this environment. We talk about some of our areas in, utilities that tend to be a bit more defensive, even healthcare, my primary area of coverage. Those are areas, even having some of your consumer brands. Those are, perhaps having a diversified portfolio. And then when you're looking at, hey, how do some of these more growth names fit within that overall context? I think that's the best way to hedge in this environment.
You said there was no free lunch, but diversification has been called the only free lunch in investing, right? So it's interesting to hear you say that. Appreciate you walking us through how these products work here. We got a lot more to get to, but before we do, just a quick note to our viewers here. If you're not following TD Direct Investing on social, you should be. Okay, we're on YouTube, we're on Instagram, we're on Facebook. You can get a sneak peek at upcoming episodes, as well as a ton of other content designed to help build your investing knowledge. And speaking of upcoming content here, check out what's coming up on the Money Talk podcast.
That woman who said, I eat uncertainty for breakfast, no, she doesn't. She eats granola because she carries that with her as a little island of certainty to balance out the uncertainty elsewhere in her life.
We don't know how to do this. We're not taught how to deal with uncertainty.
I think it's probably the most important capability one could develop for our modern era.
Like a light switch, it's a mindset shift of just seeing possibility instead of the fearful, only the unknown.
Fascinating episode here. Make sure you check it out. It's on Spotify, it's on Apple Podcasts. Definitely worth a listen. Okay, Paul, let's get back to business here. One of the things we want to talk about is how single stock ETFs can be expected to perform. And they don't typically have a long track record. They're pretty new products here. But take us through the theory and I guess the relatively limited history that we have here. How are they expected to perform in certain market conditions? Is there like a best and a worst sort of environment for them?
Yeah, great question. And this would be somewhat applicable to covered calls in general. I would say also, talking about diversification, the one thing that we're delighted with is within our HHIS, that's our 15 stocks, 15 single stocks, all in one basket. Just the way that the yin and yang for a relatively higher growth portfolio, it's done what it should do. In fact, I would say better in this environment. So the first thing that we have to think about when we're talking about individual stocks, though, is what's driving the individual stock.
Right.
That's number one here. So we might be in a bull market, but one of the particular underlying stocks, has a hiccup. Or is performing exceptionally well above market. So that's number one. So we'll just sort of categorize it, that all are moving, in the same direction. I would say that the best environment for a covered call is one that is just gently up a little bit every month. And so the reason behind that is that $100 example that I gave before, we're usually writing our options at $101. Thereabouts. And so that gives us that 1% of upside capture plus the big premium. So if I could have just 1% up every month, I would be just delighted. That's probably not going to happen. Similarly, in a sideways market where we really don't have kind of a very flat market where we can generate that premium, that's another environment that we would perform very well. In a very strong short bursts up, we'll lag the market, or the stock will lag the underlying stock. And that's the trade-off, is you're only getting 2/3 thereabouts of the upside on the stock, but you're getting that premium that gets paid out. Sort of a misconception that I think is out there that, a sideways, highly volatile market is the best environment. It really isn't. A sideways flat market is, but with high implied volatility. But a sideways market that's moving up and down in very meaningful ways, month over month, for example, or if you're writing shorter durations, week over week, that's where we can miss the upside on the first month and capture the downside in the next month. So that would be kind of the environment that becomes probably the most challenged versus something that is more of a downward trending market on a total return basis. You would expect to outperform. Again, it's a function also of how each of the stocks move individually, how they move month over month. But in general, your best case scenario is gently sloping up. Kind of the worst case would be big intra-month moves. And then kind of in between that would be where everything's down, you'll probably outperform, but you're still down.
Right. You're down less.
Down less, that's right.
Okay, that makes sense. I mean, speaking of volatility here, there was certainly a lot of it earlier this year. Things have seemed to have, petered out a little bit for now. I think a lot of people are expecting that it'll pick up again at some point. In an environment like that, what do you foresee would happen with some of these single stock ETFs? You're the CIO at Harvest here, so give us your outlook for the markets and how you think that these things might perform.
Yeah, I think the first thing I would say is time invested versus timing investing. It's really tough to do that. So I'm a big believer in being invested. And so as far as the market, you're right. We had some pockets of volatility earlier this year, and in our implied volatilities have continued to stay very high. So that's great for our option premium. The analogy that I like to use, though, is somebody about to touch a light socket or a plug. You're going to get a shock. We know we're going to get some volatility in the market. We're likely to. We still have ongoing wars over in the Middle East. We've got geopolitics that are flaring up and trying to be contained, although the tariff tantrums have toned down, and justifiably so. But they're still within that tail risk. So from our perspective, we want to be invested. We still very much like the being in the growth names. We're huge believers in AI going forward. But having that balance, like I said before, perhaps some utilities and some of the more defensive areas within a portfolio in this environment is going to make for a lot smoother ride as we kind of look out over the next 12, 18 months.
Okay, so let's say an investor's like, I like this idea of a single stock ETF. I think there's a place for them in my portfolio, but I am concerned about the volatility that could be coming here, that whipsaw volatility that we saw earlier. Are there certain qualities that they would look for in a single stock ETF that might help them, I guess, reduce that potential for nastiness?
Yeah, look, I think there's a couple things they can look to. Is there's some great quality names out there that perhaps within our lineup, having a diversified portfolio of them without the leverage. So our non-levered include Microsoft, Nvidia, Eli Lilly. We've got other features. You can buy them in USD, but they're offered, and we've got 4 in total that are offered with modest leverage and some non-levered USD, Canadian. And then just from inbound demand, we actually have had a lot of people ask for a non-levered version of HHIS, which is that basket of 15. And so I can't talk a whole lot about it, but we have certainly looked to add that into something that we might look to into the future. And so I'll leave that part of that. So okay. keeping the leverage, where you think it's appropriate. 25% we think is modest. A lot of people are using single stocks in the U.S. where I think there's a little bit more appetite for 2 and 3x. That compounds very quickly in both directions. So if you're worried about the environment, perhaps consider how that much larger leverage really works.
And again, explain it to me like I'm 12 here, because we didn't touch on it earlier. How does the leverage impact the ability of these funds to generate yields?
Yeah, great question. So within our lineup, again, we've got a number that don't have leverage and a number that do use modest 25% leverage. And the whole intent there is that it allows us to generate more cash flow. So it's relatively modest. It's at institutional rates. But as opposed to just writing on, a third of 100, we're writing on a third of the 125 in our portfolios. So again, purpose of the leverage, it does give us that ability to generate the cash flow. No, again, it's modest, but it's still leverage, so it does compound the returns to the upside and to the downside. Right,
and so the idea here is that the leverage helps you just essentially buy more of this underlying stock, and then therefore you're going to be able to write more calls on a gain.
Bang on, yeah. That's exactly how it is, yeah.
Okay. Speaking of asset allocation and stuff like that, is there a sweet spot that you think makes sense for these types of single stock ETFs within a portfolio for your average investor, or like maybe a framework for them to think of when they're trying to decide how much or how little they should have in their portfolio?
Yeah, I mean, it's going to vary for everybody, Rob. Like, you know, we talked about this before. I tend to be fairly risk averse. I've got 10% allocated to higher growth in my portfolio. You know, for somebody that's a retiree that's maybe on the 60-40 side, that, you know, is similarly risk averse, you know, they could make a decision on how much to allocate to these particular strategies. And again, do they need that high income? That's really a key attribute. And so again, everybody's going to be a little bit different, but it's a great tool in these, whether it's an individual stock that they particularly like, that they want to get exposure to and add in and around some of their other holdings, or if it's a basket of, you know, 15 that they can buy in a one ticket solution. It's going to vary for everybody on how much risk they have within their portfolio. But I would say the way to think about this is for the area of growth within your portfolio, these are great solutions. Just which ones to add and, you know, how much to allocate, that's going to be an individual different for everybody. Yeah.
Stop me if this is a completely wacky question here, but could I write options on my single stock ETF that writes options? Like, is that a way to kind of like juice it even further kind of thing? Or what do you think about that idea?
You could. It's kind of defeating the purpose, I guess, right? You know, that, yeah, you know, you're gonna end up in that situation, depending on how much you're writing. If you can get options on them anyway, there's not a lot of them have options, but they do have options in the U.S. And so you can compound a lot quicker if you're writing options on 100% writing option strategy. You know, we only go up to high risk in our ratings, but you know, there might be another notch that could be added.
That would break the risk.
Again, that's not really something that we have in Canada, but you know, somebody might want to try that strategy. But you know, I don't think it's necessarily something we would ever look to do.
Right. Okay. Just trying to think outside the box here. You know, throw some ideas out for people. Thank you so much for clarifying how these products work and what we can kind of expect from them. Just a note to our viewers here. Again, we got our live Q&A with Paul coming up real soon. So if you haven't submitted your questions yet, make sure you do. Again, if you're watching on Webbroker, the chat box is there for you. Our broadcast platform, it's the questions and comments box you want. And if you're watching on our YouTube live stream, again, click on that description, the link in the description, I should say, and it'll pop you over to the broadcast platform where you can ask your questions. Before we get to that Q&A, though, I want to bring in my colleague, Caitlin Cormier, okay, because she's going to show us how you can get your research started on single stock ETFs. So, Caitlin, welcome to the show. Good to have you back.
Thanks so much, Rob. Happy to be here.
Yeah, so take us through it. Like, how can investors start screening for single stock ETFs in Webbroker?
Yeah, absolutely. So it's a bit tricky. We don't have a specific screener that talks about single stock ETFs, so we have to be a little bit clever here in going through to get these results. So follow me into Webbroker, and we will take a peek at the ETF screener tool. So first, we're going to start by clicking on the research section. Once we get in there, we're going to come to the screeners button here. Once we're there, that is where we are going to go ahead and select the ETF tab. Once we're there, we're going to create our own custom screen so we can put in the criteria that is important to us. Now, these ETFs are actually going to show up under the fund category. So we're going to click there, click to add criteria, and it's going to be alternative other. So this here, where we can see Canada Alternative Other, that's where those ETFs live. I'm going to deselect mutual funds for the purposes of going through here. Another thing we can do maybe to help filter down a bit more is we could go into dividends, which kind of just represents distributions in general. And let's choose distribution frequency and go with monthly. So I'm going to go ahead and we filtered down a bit here to 45 matches. So let's go ahead and view those. So we see here that there are a number of, so we can see right here, we've got a lot of purpose ETFs showing up here. As we scroll through, we're going to see Harvest there as well. So we've got lots of these single ETF single stock ETFs that are showing up here. The reason why I chose that monthly distribution instead of sort of, the distribution yield is because some of these ETFs are quite new, so they don't actually have distribution yields showing up yet. So because of that, that's one of the reasons why I went ahead and just chose the other. So yeah, there's lots of information available on these ETFs, and choosing that monthly tends to get us these specific ones. So as you notice here on the right-hand side for these Harvest, you can see these actually don't have MERs or distribution yields showing up because they are very, very new. So under profile, it'll show us they've only been out since 2025. So it takes a bit of time for the results to actually show up and be able to show here, but that alternative other is the category we're looking for. And then if you hit the monthly distribution, that should get you potentially to these results.
I love it. The tricks of the trade. You know all of them here, getting us the workarounds here. Awesome. Now, Paul and I were talking a little bit earlier about the value of a little bit of diversification if you're investing in, kind of ETFs that have covered calls on them here. The screen that you just ran, does that include more diversified names as well? And if not, how could somebody track those down too?
Yeah, a lot of the ones that show up in that category specifically are more like the crypto, different types of ETFs. So if you're looking for a more diversified ETF and you're looking to add that covered call piece to it, so here's what I would suggest. So because there's so many of them out there, you really have to first choose which area of the market you're looking to diversify into. So whether it's the US or Canada or a specific kind of area with sector or kind of area within the market. So let's hop in and take a peek at how we could do this. So I've gone back to my fund categories here, and instead of alternative other, I'm just going to choose, for example, Canadian dividend and income equity. Now I've stuck with that monthly distribution here for this particular ETF, and I'm going to click to view 23 matches. Now in this case, again, the reason why I chose that, and I could also put in that sort of higher yield to narrow this down as well. But the things that I'm looking for are, so obviously this first one right here says covered call. We also sometimes see enhanced return is another word that we can look for. I think Harvest tends to, let me just see here, income leaders, I think is a terminology that Harvest uses to kind of specify their particular ones there, or enhanced yield. There's lots of different kind of terminology, but anything that has either covered call or some of those sorts of kind of boosted returns, you can find them in all different areas within ETFs. You just have to kind of look for that specific verbiage and potentially keep things like the distribution yield as being kind of above average or monthly to try and find those specific ones. And then also here, if I go to, I believe it's under, let me see here, what is it under? Performance? No, I think it's under summary. This will show the distribution yield. So you can also just rearrange the products based on the highest distribution yield. And that can give you an idea as well, which ones might be looking at an enhanced yield.
Okay, so again, showing us how to track things down here. Obviously, if you have any questions about that kind of stuff, it's probably best to consult the fund facts document for any of these things just to get total clarification. But appreciate you giving us a leg up on our screening here, Caitlin. Appreciate you joining in this program as well. We'll see you next week, okay?
Thanks, Rob.
All right, that was Caitlin Cormier. She's TD Direct Investing's Senior Client Education Instructor. Okay, without further ado, Paul, it's time for the Q&A. Are you ready to hear what our viewers want to know more about?
Absolutely.
All right, let's bring it on here. We got a question from Ali coming up here, and Ali wants to know what can go wrong with a fund that is promising, say, 160% yield, like we talked about earlier here. What is the worst case scenario? Put your doomer hat on for me, Paul.
Goes to zero.
It goes to zero.
That's your worst case scenario. The flip side is that you're getting compensated with very, very large incomes, and so something like with 160% yield, though, to me, that's probably somebody that's writing 100%. And, I think more realistically, what a worst case scenario is that over time, you don't get any of the upside in the individual stock. And therefore, over time, yes, you're going to get paid that cash flow, but you'll get the downside on the stock and really never the upside. So that would be more realistically your kind of risk return in that environment. So, what's the sustainability of the stock? How long is it going to stay, not go down? Those would be questions. But that something like 160% distribution yield, yes, like that's something that is probably writing that 100% or has fairly aggressive leverage. So I would put that in that kind of that other column of risk we were talking about beforehand.
Yeah, like just so I understand correctly, you would basically need the stock to continue just a really great march upward to compensate, right, for that super, super high yield you're getting?
Or the stock is not going to go down. And so, if you're writing 100% on a $100 stock, yes, you're going to get the equivalent of 160% annualized on a monthly basis. But if it goes down to $90 the next month, you're only getting it on the $90, and then it will never go back up to 100 because you're sitting at 90. So the stock might go back up to 150 the next month, but then goes down another 10%, you're sitting at $80. And so yes, you're getting big yield, but over time that NAV would go down if you're writing 100%.
Mm-hmm.
Yeah.
Okay. Michael's got a question for us. Michael wants to know, I think the main issue with the majority of Canadian ETFs is liquidity. What is Harvest doing, and what can it do to improve the situation?
It's a great question, and actually there's some commentary with the regulators right now just talking about having more market makers on various types of funds, what that liquidity provision looks like. I know from our side, generally the liquidity is very high, and quite often there's the primary and then the secondary liquidity, and so market makers are out there basically making markets in and around where the intraday net asset value is, and there's an underlying bid-ask spread to those stocks. And so quite often when you have a large liquid fund like our HHIS even, or I look at HHL, our healthcare fund, these funds are trading a lot of volume, and that actually means you can be buying inside where the actual net asset value is. From our perspective, we've got multiple market makers on all of our ETFs, and we actually monitor that continuously throughout the day. So the notion that looking at an ETF and saying it's illiquid because it hasn't traded really isn't true. It's a function also of what's the underlying, and can the market makers actually make a market. So we published something not long ago on our website relating to a little bit of an adjunct conversation, but when the US markets are closed, for example, and the Canadian markets are still open, there's really no way you're buying that underlying stock, but yet the underlying market isn't open, right. And so there has to be an offset to that, and that's when we can really see some anomalies on where investors are, perhaps overpaying or selling below, just because there's no way for the market makers to actually offset. So those types of environments, we stress caution on those handful of days of the year that the U.S. markets are closed, and the flip side is true as well. So, but generally, when we're looking at our funds, multiple market makers, lots of liquidity on the underlying stocks, we're quite confident in our liquidity that we have.
Okay.
Yeah.
Interesting question there, Michael. Amy's got one for us as well. Amy wants to know what kind of expiration dates, strike prices, and deltas are used for the covered calls. Let's use your portfolio at Harvest as an example.
Yeah. So we're typically writing 101. And we're typically writing 30 days. Some of the funds we actually have rolling 30 days, so meaning I'll have 30 days expiring in 2 weeks that will roll for 30 days, just depending on the fund. But generally, we're writing at 50 delta with 101 calls, typically 30-day rolling. So in some of our I'll add a little bit extra context to it. In some of our active mandates where we're actually making judgment calls around earnings releases, and sometimes we'll be a little bit more active writing further out of the money. We're always monitoring all of our funds for opportunities to buy back our options. So market sells off, we've captured 95% of the premium, why not buy back that option and then fully participate on the upside? So we've generated the requisite cash flow for the month, but basically capture any of the bounce to the upside.
Interesting, yeah. So it's not just like a set it and forget it on the option expiration date here. It's very actively managed throughout, right?
That's right. That's right. And so for the cash flow generation, and it's actually another, the question hasn't come in yet, but what we do at Harvest is at the start of every month, we actually just recently did this a few days ago. We basically take all of our portfolios, and including the single stocks, and it sounds like it's simple, but there's a lot of moving parts. What's my distribution per unit times units outstanding? That's how much cash flow I need to generate that month. And then we look at all the different, we've got a whole bunch of different option modeling metrics that we look at, the Greeks, et cetera. But generally, we're looking to say, how much do I need to write to generate that net cash flow? And within the single stocks, like I said, it's varied kind of between 25 and 40%. Typically fairly systematic in and around that mid-30s% right levels.
Mm-hmm. Okay. Man Binder's got a question for us. Do covered call ETFs have a higher return than leveraged ETFs?
It's that's 6 of one, half a dozen of the other, or what comes first, the chicken or the egg? In an up market, your levered funds are going to have a higher return in general, depending on how the leverage is structured. And so in a down market, you'll have that cash flow to rely on within the covered call. But I would argue actually that comparing the two are really kind of two separate parts to your portfolio. If you're just looking at pure levered, adding leverage and not necessarily at what products or what structure of investment you're looking at, it's a different type of investment.
They're trying to accomplish different things.
Yeah, they're trying to accomplish different things, I would say. Now, if you're talking about adding some modest leverage to a covered call, yes, you get more cash flow, more participation, but you get more downside.
Mm-hmm. Yep. On like a total return basis, though, it sounds like the leveraged aspect would probably get you more. Is that fair?
I would think so over a cycle. But it's again how the stocks move over time. But I don't think that would be unreasonable on a total return base if you had a modest leverage. Now, and generally an upward market over time is how we view the world. But how it goes from A to B in month over month will also impact that relative performance.
Okay, well, thanks for breaking it down for us. That's all the time we have for Q&A here. But Paul, it was great chatting with you. Thanks for coming in. We'll have to have you back again soon.
Thanks again for having me. Appreciate it.
Right on. And for our viewers too, of course, thanks for tuning in. Make sure you check out next week's show here. We've got a really fantastic rags to riches type kind of story here for you. Our guest, Jackie Cummings-Koski, had just $20,000 in her retirement account when she got divorced in her mid-30s. Less than 10 years later, she achieved financial independence with a portfolio over $1 million. Incredible stuff here. We're going to hear how she did it and some tips for others who might want to quit the 9-to-5 grind a little early too here. But for today's show, that's all the time we have. Thanks again for tuning in. From everyone at Inside Investing, we appreciate you, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.